This is the Real Estate Investing Abundance Podcast. I'm your host, Dr. Allen. I just want to take a moment to introduce you to our company, Steed Talker Capital. Steed Talker Capital is a real estate investment firm. If you'd like to learn more about real estate investing, head over to our website, steedtalker.com. And while you're there, take a moment to get your one-page guide to the 10 steps to passive real estate investing. Downloading this PDF will also enroll you in our Enlightened Investor Circle, and by enrolling in the Enlightened Investor Circle, you'll be the first to know about any new investment opportunities that we are getting involved with. Look forward to hearing from you. Enjoy today's show. Hello, enlightened investors, and welcome back to Real Estate Investing Abundance. I'm your host, Dr. Alan Lomax, and delighted to be back with you again today. We are going to take a look at appreciation acceleration, uncovering rapid growth, hotspots with Mark, the real estate maverick. Mark Updegraff is a real estate investor, broker, and business owner focusing on revitalizing Rochester, New York properties while leading the Updegraff Companies. He is passionate about community development, raising capital for diverse asset classes, fostering innovation, nurturing teamwork, and actively developing multifamily spaces in Rochester, New York, of all places. So, Mark, welcome to the show, and take us into the show and share a memorable experience that helped you to be who you are today.
Thanks, Alan. I'm really excited to be here. I've had so many memorable experiences. It's really hard to pin it down to just one. I'll tell you a story. My mother actually gave me this idea when I was younger. As a young kid, I always wanted to earn money, but I wasn't old enough to get a job. So that was a real problem. And my parents really instilled hard work, so they gave us chores. I was able to do the grass, but it just wasn't enough money to, I wanted to make a savings to eventually invest. And my mom gave me this idea that I should go and pick strawberries and then resell the strawberries. And of course, I was really busy with swim team. My parents really advocated that we were, had an active lifestyle as a kid, and we were always on swim team and getting coached. So in the mornings, real early, she would drop me off at the crack of dawn, and I would pick strawberries for a few hours. And then I would bring them home and clean them up and then resell them. And, one of the early problems that I saw was like, how was I going to find all these people to buy the strawberries that I was picking? I'd pick, probably 50 quarts at least a day, and really was having a problem turning them around. So again, my mom came through with a novel idea. She said, hey, why don't you take them over to the old age homes and set up a little table down in the lobby, and I'll bet you could sell a few strawberries. And that kind of catapulted my entrepreneurial career as far as being able to make as much money as I was able to do as far as output goes, right? Where I was in control. I was setting the price that I was charging, and I was in charge of building those relationships with the clients to get repeat business. So they knew that, they wanted me to come back the following week. They'd say, hey, definitely come back. We'll get more strawberries from you. When prior to that, I had a little business helping my father by cleaning his power equipment. He was an owner operator of a trucking company. And, he would bring his truck home and I would polish the wheels, but he set the rates. He said, okay, I'll give you $5 for this. I'll give you $3 for that. And it was grueling work, and the hourly rate, I was appreciative to make that money. But when I got to the strawberry side and I could set my price and I could pick as fast as I wanted to pick and really get those, I realized that, there is something to entrepreneurship when you actually control all the parameters yourself.
Well, a great learning experience, and what a fantastic mother you had to guide you and direct you in those directions when you were somewhat stuck yourself. Excellent.
Mm-hmm.
Well, how do you identify areas that may experience higher than average appreciation for metropolitan statistical areas, which can be quite tricky? How do you know where the growth is going to go and where it is going to decline?
That's a great question. So there's a lot of different metrics that I use to kind of craft my thesis. Ultimately, you've got to get into the field and really do a lot of exploring. So the most critical thing to do is to break up your MSA into as small segments as possible, where you can delineate a difference, right? So a lot of times arterial streets will be this like psychological border. Waterways can form similar borders, parks, schools, businesses, shopping districts. So by going into your MSA and really exploring the streets, you can kind of see how things change from street to street, block to block, and you can compartmentalize. Once you've got that compartmentalized approach, you can look at different metrics across that specific area. So I'm looking at cost per foot to purchase, to acquire. I'm looking at lease rates per foot. I'm also looking at where the first-time home buyer demographic is headed. In a heated marketplace, it's very difficult for them to acquire Class A real estate because the conventional or cash offers are going to beat them out, 10 times out of 10. So they're going to need a new spot to go. And given that they're limited on what they can afford, they're typically not going any higher price per foot. They're typically going to a lower price per foot. So just getting those blocks chunked up and then examining a gross rent multiplier overlay, examining a price per foot overlay, you can start to see how the real nice areas will influence some areas that might be neighboring it, but still have lower gross rent multipliers or lower price per foots. So when you look at it on a map, you can kind of see areas that are well positioned to be absorbed into a higher number, or at least to trend up towards that higher number, right? Because we're going to have spillover from maybe you're looking at a 10 gross rent multiplier and you can't get into that neighborhood. You can probably get into like a 6 or a 7 gross rent multiplier. And if you can find one that borders like an 8 or a 9, you're in the path of progress, versus if it was, say you're buying in a 6 gross rent multiplier, but you're surrounded by like lower numbers. Now you're going to know that you're probably going to trend lower instead of trending up. So really breaking it up and looking at it. So if you looked at my overlay for Rochester, I would tell you I've got minimally probably 100 different segments that I've identified as compartmentalized areas where I've calculated a specific gross rent multiplier. And then using that, once you dive into the opportunities in those areas, so you're monitoring the listings that are coming to market, or maybe you found an off-market deal, you check the map and you do some calculations to see if you're purchasing something that's undervalued or overvalued.
Well, that's very impressive with what all you're doing there, which tells me that you know your market backwards and forwards. And how long did it take you to develop all of that expertise and projection in conjunction with your market?
Yeah, it's been a work in progress, for the last 15 years. And I would tell you that intuitively, I had been doing it all along, just more in my head than on paper. And then as I got investors that wanted to come work with me, and I had to explain the different nuances and why I was calculating things the way that I was calculating, and why I was advocating for particular locations versus other locations where, the numbers in one location might look better than the area that I would advocate, I would have to explain to them why I believed in my thesis, and show them some studies of different markets that had gone through this revitalization cycle. It's typically like a 3 to 5 year spin when you're looking at an area that's, like I said, it's going to be kind of connected to some nicer areas, but maybe also bordering some not so good areas. And when that happens, you've got your first-time home buyers that start to go into there. They need places to patron, so some businesses will start to root. You'll get some new restaurants, some bars, maybe a coffee shop or something like that. And what happens is that first-time home buyer advocates for that neighborhood because it's where they live. They've planted their flag. They want it to be something special too. And now their friends start to gravitate towards that marketplace. Plus, the new first-time home buyers are still buying in that market as long as they can afford it. Over that 3 to 5 year horizon, when it gains popularity, unfortunately, the cycle repeats itself. And now all of a sudden, your first-time home buyer can't afford it. And not that they can't afford it, it's too competitive to get into it because they're the lowest offer on the stack. Now, if you're in a market where it's a buyer's market, sure, the things are a little bit different, but we haven't seen a buyer's market since 2010 maybe, or 11 or 12. I don't know when exactly it shifted. It probably depends on what market you're in exactly, but we've had multiple offers for a decade on properties. So operating in this space, that's kind of how it works. And I would tell you, over the last 15 years, I've followed different markets that have done this and been successful, not only for myself, but for my investors, where if we purchase something conservatively and we've got a real conservative underwriting, we're going to allot for property management, vacancy, CapEx, repair, then we're going to subtract out the operational costs. So it's a pretty refined pro forma, and we're getting good cash flow. we want to make sure that when we re-leverage in the 3 to 5 years and we pull that equity out that we had put in, our 25% or 20% equity, if we pull that out, we want to make sure that we're not sending that investment into negative territory where now we're subsidizing it because we took that extra equity. So we're doing the Burr method, we're getting the equity back out, but not only that, we're able to position it as a long-term hold position that's going to more than cover the cost of the asset and produce a small amount of cash flow. Now, the cash flow won't be as rich as it was on your initial acquisition because you've pulled out that additional 20 to 25% equity, but you're still making some money. And if you're making money with $0 invested, it's an infinite return. So that's the model that I've followed. That's what I've practiced. That's what I've taught people. And it's been a really successful model here in Rochester.
Well, you just mentioned the Burr model, and I think probably many of our audience know what the Burr is, but tell us what Burr is.
Yeah. So just a simple way to explain it is that you're trying to get all of your equity back out of an acquisition and still keep it and cash flow it. So you have $0 invested. A lot of people, cash investors, can do this a little bit quicker, right? So I just talked about the 3 to 5 year horizon, which I think is a good play, but you could do it a little bit quicker if you're a little more sophisticated and you've got a pretty hefty cash position that you're working with. So if you acquire something with all cash, you do your value add, and then you take it to the bank and refinance it. If you run your numbers right and you know your comps, you should be able to pull the majority, sometimes more than your investment back out. I've received 120% of my investment on some earlier deals that I've done where the market just kind of supported the fundamentals of the deal. It's difficult right today to get 120% out. I'd say you're almost hard pressed to get 100% back out today, but that's the ideology, right? You want to buy something, fix it, increase the value of it so much that now the bank thinks it's worth 120 to 125% of what you've actually invested in the asset. Then they underwrite it, they give you the 75% loan to value, and you've ended up pulling all of your cash back out of that investment.
Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. Well, metroplexes can be tricky areas no matter where you are. But if my memory serves me correct, Rochester was the home of Kodak. Is that correct?
That's correct.
And Kodak took a major dive when digital came on the market, and they weren't really prepared for that. How did that affect Rochester?
It had a huge effect. So Kodak was in a position to really dominate the digital space. They had the first digital camera, and they owned the Bayer patent, which was one of the most valuable patents of all time. It was in every single imaging sensor that was ever produced at the time. Fuji, Canon, everybody had to pay Kodak to use that proprietary sensor type pattern, Bayer pattern. And, they thought that emerging markets were going to buy film, and they didn't listen to the scientists. And they said, hey, we like digital, but we're not going to invest heavily in it. We want to eke out as much profit from film as we can because the margins are so high. The emerging markets skipped the film. They said, we don't want film. We want digital. And they jumped right into digital. And at that point, Kodak was too far behind the 8 ball to ever catch up. So not only were we home of Kodak, we're also home of many imaging companies. Xerox was home base here. Bausch and Lomb had a huge presence here, and many other smaller imaging firms. And all of them, unfortunately, have done some level of downsizing or offshoring. And Rochester's been hit really hard on the imaging front. We used to be an imaging powerhouse, and now we are the skeleton. And you can see it in these mostly vacant office complexes that were housed by such corporations that are now finally starting to get repurposed and put back into service. But it really killed our downtown. Our bustling downtown turned into a ghost town. And even today, it's still in its infancy of coming back. We've got a lot of tax incentives, which is helping. These developers are eligible for 20% state, 20% federal if they're going to come in to a certain district and reposition some of these aging office structures into something that's going to be useful. So there has been a lot of activity over the last 5 years, we'll say, but some of that stuff still isn't online yet. I'd say maybe we're like 30% through all of the conversions that people are working on. And it just doesn't feel like the residents are taking hold of the area the way that it needs to be in order for the businesses to be successful. So we've had a lot of entrepreneurs in like the real estate space, not real estate, I'm sorry, the restaurant space, that have come in and they've been like, okay, I see what's happening. I see that there's all these luxury apartments coming online. They open their businesses, including a grocery store, which everybody said was needed in downtown and wanted, and they were going to use it. They all went under. And I don't think it was any fault of the entrepreneur that opened those establishments. I just think that the people aren't there yet. And I don't know how long it's going to take to really shift. I'm hoping that, we're looking at maybe like a 5-10 year horizon as these things come online, but we really haven't gained the necessary traction to refill our once bustling downtown yet.
Well, given the challenges in conjunction with what Rochester is facing, why did you, as a real estate investor and entrepreneur, decide to actually pitch your camp in Rochester?
So I came here in 97 to go to RIT, and we really fell in love with the people and with the area. The city is big enough that it has a lot to offer, but it's small enough that it's not cumbersome when it comes to travel and parking. So it's very walkable, and it's very diverse culture too. We're real heavy on education. So there's a lot of really smart people here from all different disciplines. There's a lot of creativity that happens here. So I really kind of fell in love with that aspect of it. And the cash flow, our average income for a family is pretty low here in Rochester. So there are a lot of cash flowing property opportunities if you want to purchase that type of investment where you're maybe getting the mailbox money, the DSS or Section 8. I tend to go towards more of a blue collar approach in my model. And that's specifically because of what I spoke about earlier, where I'm looking for identifying these markets. That's where they tend to be. They're not going to be in the more cash flow heavy areas. But as an investor and a property manager and a broker that's working with other investors, we're happy to service everyone, right? So we still manage properties all across the city, even in some tough to manage places. When those units come into our management, we make sure that our clients' vision and values align with ours, and we can't take every single owner if they don't, right? So if they're not willing to put money back into the properties, we really don't want to have our name associated with that type of operation. Mm-hmm. So unfortunately, the way that the housing stock is and the way that the rents are and the way that the cost of acquisitions are, people that buy those cash flowing units, especially if they're not local to Rochester, they look at the back of the envelope. It looks like it's going to be real good. And then what they end up with is a manager that can't really manage it properly because they don't have the infrastructure or the staff to deal with this type of laborious work. It's more work to deal with a Class C, Class D property than it is a Class A. It's absolutely, I don't know how many times more, but it's significant. Mm-hmm. So they buy those properties, and typically they'll bleed cash for like 3 to 5 years and then they'll exit. So we have this constant cycle of people, they come in and we explain to them what we recommend them do. And then it's up to them whether they want to listen to us or not. But personally, I don't invest in that type of asset. I think the back of the envelope breaks down significantly when you start to look at your eviction costs, your deferred maintenance costs, your turnover costs, and your bad debt. So by operating, and planting my flag and then kind of checking on both sides, I've steered towards the more conservative side where I'll trade off cash flow in order to get a superior location. Mm-hmm. So that's my model. But the people that run the cash flow game, they tend to be locals that are very in tune with their marketplace. They're not scared to go knock on the doors in some of these rough areas to collect rent. That's not part of our business model. We don't go chasing for rent. We require the tenant pay the rent, and if they don't, they get evicted. So, if you're saying, hey, I'm going to be a cash flow millionaire, you need to have boots on the ground, probably yourself. You probably got to be strapped, and you're going to have to go knock on the door every day until you get your rent. If you even get your rent, you don't have to evict. They're completely different models, and I think people that are looking from afar just don't understand that nuance. They buy the wrong thing. They get a bad taste in their mouth for Rochester, when if they would have just done something a little more smart, which is trade off cash flow to get a better asset, they would be loving life right now.
So you consider yourself a big class investor? Is that what you would say, or a high C?
That's a good question. There are probably transition areas that would be considered like B- at best, or probably C+, that are then going to transition into that B pretty quickly, and then get lifted into A territory over the course of 10 years, right? The first 3 to 5, it's quickly ramping into B and like maybe even B plus over that shorter term. So you typically see about anywhere from $40 to $60 a foot in appreciation on the product without doing any value add, just by simply buying it at the right time. So my model would be to, get into that asset class, find something that, I call it the little old lady house. It's really just a house that's been well maintained. Typically, they haven't traded hands too many times since they were built, and they tend to have some of the CapEx already done for you, the roof, the mechanics, the windows. They trade for approximately the same price as a rental property that's traded hands a million times and has had a billion families going through it, busting it up. So I'll pay the $2,000-$3,000 premium to get the little old lady house in that area. I'll operate it exactly as it is. So it's going to have shag carpet. It's going to have a 1960s, 70s kitchen that's been well maintained. It's going to have a pink tub and a pink toilet. I'm still going to hit a good market rate. But for me, it's not worth coming in and spending, let's say, $20,000, $30,000 on a kitchen, a bathroom, floors, and paint to get an extra $250 in rent, when I could just operate it the way it is, have a great cash flow, burr it, bring all my money back out. And then at that point, if I want to reinvest in it because the market's shifted and I know I'm going to get a good tenant, and now my spread on my rent, instead of being $250, it's 3 years later, the area's improved, rents are probably up now $500-$600. Now might be the time where I go back and I put that 20, 30 grand into it. And now I get the increased rents.
Sounds like a good strategy there. Well, there is certainly disagreement in the investment world in terms of vertical integration as opposed to outsourcing. You have selected to go with the vertical integration in terms of your operation and management. What is the basis for your decisions on that?
It's really hard to control third parties when it's contractually, it's the same with the service industry, as far as getting work done. Their priorities are going to be revolving around their business, right? So if they've got a new client that's having them do something where they're getting paid really well, you might fall to the back burner, where before you were, they liked your relationship because you were giving them consistent work and you always pay your bills. But now they've got some client that's overpaying, we'll say, because they really want the work done or they just don't know any better. Now you're at their mercy, right? So they might promise you one thing and then the delivery just might not be exactly what you had hoped for. So by vertically integrating both the management and the service side of the equation, we're able to control who goes where, who does what, and we're able to keep our pulse on a lot of these things where, if you ask a third party a question about why something went wrong, it's easy for them to point the finger at somebody else. Then you ask that person, because they're going to blame their vendor. You ask the vendor's going to point their finger somewhere else. And you spend a lot of time just trying to figure out what's going wrong, what the problem is and how to fix it. Where if you are in control and it's your system, you're integrated, you can figure it out because there's more accountability and there's less of the blame game. So I found that's been really important for keeping clients happy, getting things done quickly, having our turnovers, actually happen a little bit faster to keep our vacancy rates down. Right. So sometimes you don't know when something's going to happen, right? Maybe somebody moves out in the middle of the night. And if I go to a third party vendor and I say, hey, I really need to get this thing turned around, they'll be like, hey, this is the busy season. I'm booked out 6 weeks. I'm booked out 8 weeks. It's not uncommon for people to book out for an entire season. Right. So I've got to get my subs lined up early. So like I've already lined up a lot of subs this year, and I'll continue to line up subs. So I'm guaranteed to have subs when I need them as we get into the busy season. If you have an emergency during the busy season, you're probably not getting a sub anytime soon. So having that human capital to be able to pivot and say, okay, guys, I know we're working on this project, but I need 2 of you guys to go over and deal with this for me because we have an emergency. There's a lot of goodwill that you'll get from your clients by having that flexibility, because they're understanding that there is other work to be done and an emergency just happened. But at the same time, if you're able to tell them, hey, everybody's booked out for 6 to 8 weeks, but I'm going to send 2 guys over to take care of this for you, so you don't have to wait. That goes a really long way with goodwill, and it's going to keep your clients so much happier, and they know that you're really looking out for their best interest.
Yeah. We'll have a couple more questions, but before we go to that, tell us what you have to offer and how our audience can get in touch with you to take advantage of that.
Yeah, so I love helping people, and that's kind of had my aha moment not too terribly long ago, where I've been operating in the real estate space as an investor, as a broker, as a manager, building these companies, and I loved that, and that was kind of my favorite part of the job was helping somebody get into a good investment and set themselves up for future successes in the real estate market. And so my aha moment was when the window of opportunity for the asset class that I had been operating in, typically the 1 to 4 family space is where most new investors come and they start to dabble. And then as they build and as they grow their wealth, they'll get into some of the medium sized assets. I really wanted to take what I know how to do and translate it to people on a larger scale. So instead of helping people individually purchase a property here, a property there, and build a portfolio, we still do that. Obviously, I've got agents that run around that would love to do business and help people, and then I've trained them on my specific ways, like we talked about, with positioning and doing the BRRRR and all that. What I'm focused on now personally is getting into larger deal syndications. And so over the years, I've gotten really good at deal sourcing and networking. And so I've got a good pipeline of people that will bring me opportunities off markets that actually make sense when you underwrite them. If you go to MLS today, it's really, really hard to find something. But for instance, I was networking and I met an older gentleman he's 87 years old, and he's purchased, hundreds of units that he still owns, and they're all in Class A space. And, it was just kind of talking about what does his exit look like. And he was like, I really don't know. He's like, I kind of know what they're worth. And, I don't want to get hit with taxes. And it just opened up the opportunity for me to be able to explain to him what his options are. And, hopefully we can work together for some kind of beneficial exchange where, we can structure it a million different ways, and ultimately I would like to bring other people in to be able to share those experiences with me. My limiting factor has always been capital, right? So I'm good at sourcing deals and taking them down, but when I'm out of money, what am I going to do for the next deal? So this methodology will allow me to continue to do what I do best, which is network, find good deals, underwrite them, create relationships, and then bring other people into those deals so we can actually take them down.
Well, how do we get in touch with you?
Yeah. So my cell phone is 585-314-9790, 585-314-9790. If you shoot me a text, I'll just get back a Calendly link and we'll be able to set up a call. I get a bajillion emails. So often I just like if people text me, that's better. I'm also at raisecapital.com, RAZE capital.com, and they can get a link directly to my Calendly from that site as well, where they can book a call with me.
Well, Mark, tell us about underwriting and how do we go about that? What's the best way to underwrite? And should we take a third party's opinion on that?
Oh, that's a great question. I think a lot of people are paying the price from taking third-party opinions on underwriting during this last boom cycle. I've got a good friend that works for a third-party underwriting company down south, and he's just telling me the horror stories. During the boom, everybody needed underwriting. So this third-party underwriting company was also experiencing the boom, and they were staffing up and hiring people, hiring analysts. But a lot of people that they hired just didn't have the experience, they didn't have the training, and everybody was trying to push the numbers to get the deals to go through. And so he's telling me that they underwrote stuff at $2,400 in rent, right? They bought at the top of the market. The market's now in these places down 10, 20%. They never achieved the $2,400 in rent. In fact, they're at $1,800 in rent. So there's this huge disparity between what happened in the underwriting and where they're stuck, and they're all in floating debt. So I definitely think that, you can use a third party underwriter, but make sure you vet them really well and make sure you do your own underwriting on top of that. Maybe you use them for a quick, give me something to look at, and now I'll go through and re-underwrite based on their numbers, and then maybe check some of the assumptions that they have in there, check some of the data that they have in there. That's how I would do it.
Yeah, a lot of people think that underwriting is just by the numbers, but there is so much art involved in underwriting, and you need to know your markets for certain there. Mark, it's just been go ahead.
I was going to say, everybody is good at moving numbers around to make things look good. So you've just got to check all those numbers, right? The rents, I think, are probably the most crucial. That's the easiest lever for people to play around with and make things look better than they should. So I always try to stay super conservative on the rents. And, I'll go to sites like Zillow or Rent-A-Meter, but ultimately I'm going to follow up with people that are managing properties in those areas to see what their actual lease rates that they're attaining are. luckily in my marketplace, I know a lot of managers, and then, we're managing so many properties that we have a really good pulse on it. If I was going into another marketplace, I would be looking for those people that have their finger on the pulse of the rent, because sometimes the sites aren't accurate. You'll have people that throw stuff up on Zillow for a high price, right? And they're maybe managing 10 properties, or maybe they're managing 20 properties. Somebody like that's going to be, have so much more time to attain that higher rents. They might be able to hit it or hit closer to it. But when you're talking about scalability and repeatability, you really want to deal with people that do this day in and day out, that are leasing things every single day, because they're going to give you the true number. You might be able to hit 1,600, but if you set it for 1,600 and you take 3 months of vacancy trying to get it, did you make out better, or should you have just leased it for 1,400 and skipped those 3 months of vacancy? So you got to know your numbers, and you got to make sure that the assumptions that people are putting in are correct. And I think those are the two key parameters to make sure that the rest of the numbers fall in line.
Yeah, wonderful advice, Mark. Thank you so much for being with us today. Thanks for sharing your expertise and knowledge with us.
Absolutely, Alan. Thank you so much for having me.
Enlightened investors, don't go yet. I have just a couple of quick requests. You know the drill. Like, share, and subscribe. But we also need your help to build our audience, so please go to your favorite podcast app and leave us a 5-star rating and review. I'll be most grateful. Until next time, prosper and live abundantly.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.